Coach Wade here, and today we're talking about something that most people never learn until it's too late: how to actually calculate your tax withholding the right way. Because let me tell you something right now, most people are blindly guessing when it comes to taxes. They either celebrate giant tax refunds every year without understanding what caused them, or they panic every April because they owe thousands they weren't prepared for. And inside the Power Team system, we teach people that financial freedom starts with financial awareness. You cannot control what you refuse to understand. Now let's clear up one of the biggest myths in America right now. That big tax refund people celebrate every year, that is not free money. That's your money coming back to you after the government held on to it all year long. That's why it's called a refund. And I know some people love that big check because it feels like a bonus. But listen carefully. If you got a huge refund, that usually means too much money was being taken out of your paycheck every single month. You've basically been giving the government an interest-free loan with your paycheck. Meanwhile, you're stressed about bills, trying to pay off debt, living paycheck to paycheck, using credit cards for emergencies, while your own money is sitting somewhere else. Inside the Power Team philosophy, we teach people how to increase monthly cash flow, not just survive until tax season. Because if you can keep more of your money throughout the year, you can build momentum financially. Now, before we even calculate anything, let's understand what tax withholding actually is. Tax withholding is simply the money your employer removes from your paycheck for taxes before you receive your money. Your employer sends that money directly to the IRS throughout the year, so technically, you've already been paying taxes little by little all year long. The question is, are you paying too much, too little, or just right? That's the goal. Not a giant refund, not a giant tax bill, just balanced correctly. I call it the Goldilocks strategy. Not too hot, not too cold, just right. Now let's talk about the warning signs that your withholding needs attention. First sign, huge tax refunds every year. And listen, I know people get excited. I got back $4,000. I got back $6,000. Okay, but let's think differently for a second. If you got a $3,000 refund and you pay twice a month, that means roughly an extra $125 was missing from every paycheck all year long. That's grocery money. That's gas money. That's debt snowball money. That's investment money. That's breathing room. Now imagine a married couple both over withholding. Suddenly they could have had several hundreds extra dollars every month flowing through their household. That changes things. Second sign, massive tax bills. Now this one hurts differently because nothing ruins a springtime like opening up a tax software and realizing you owe the IRS thousands of dollars you don't have sitting around. That stress creates panic. People start borrowing money, using credit cards, dipping into savings. And most of the time, the problem wasn't the taxes themselves, it was poor withholding planning throughout the year. Third sign, major life changes. And this is huge because people forget taxes change when life changes. You got married, taxes change, had a baby, taxes change, bought a house, taxes change, started a side hustle, taxes change, changed job, taxes change. Inside the Power Team system, we teach people that every financial move has a ripple effect. And if your income or family structure changes, your tax strategy should be reviewed immediately. Now let's walk through how to actually calculate your withholding in a practical way. First, you need to total up how much federal tax is currently being withheld from your paycheck. Look at your pay stub. You usually see a section that says federal withholding or federal income tax withheld. Let's say your paycheck has $150 withheld every pay period and you're paid twice a month. That means you're withholding about $3,600 per year. Now, if you're married and your spouse works too, you need to include their withholding as well because taxes are based on the household income. And if you're self-employed or running a side hustle, this becomes even more important because taxes usually are not automatically withheld from self-employment income. That's why entrepreneurs who don't prepare often get hit hard at tax time. Inside the Power Team system, we teach people not just how to increase income, but how to prepare for the responsibilities that come with higher income too. Because more money without strategy creates bigger problems. Now, once you know your withholding, the next step is figuring out your taxable income. This is where people get confused. But let's simplify it. Your taxable income is basically the amount of income the government uses to calculate what you owe. So first, you total up your income. Job income, side hustle income, freelance income, interest income, anything coming in financially. Then you subtract adjustments and deductions. Adjustments can include things like traditional retirement contributions, student loan interest, health savings account contributions. Then you subtract your deductions. Most people take the standard deduction because it's simpler and often works best. Now, after all that, you estimate your tax liability, which is simply your estimated tax bill for the year. And this is important because many people misunderstand tax brackets. People hear 12% tax bracket and think every dollar gets taxed at 12%. That's not how it works. America uses a progressive tax system. Some income is taxed at one rate, then additional income gets taxed at another rate. So only portions of your income fall into different brackets. Now, once you estimate your taxes, you compare that number to how much you've already withheld. If your withholding is higher than your estimated taxes, you probably get a refund. If your withholding is lower, you probably owe money. And again, the goal is balance. Because your money works best when it stays in your household throughout the year, not trapped in a refund limbo, not creating surprise tax debt. Now, if you realize adjustments need to happen, the next step is updating your W-4. And this is where people get nervous. But honestly, this is just paperwork that tells your employer how much tax to withhold moving forward. That's it. You can increase withholding if you're underpaying. You can reduce withholding if you're massively overpaying. And let me say this clearly. This is not about avoiding taxes illegally. This is about understanding how cash flow works legally and intelligently. That's financial literacy. And financially educated people make better long-term decisions. That's why inside the Power Team system, we teach budgeting, debt eliminations, tax awareness, income shifting, business ownership, and cash flow management. Because wealth building is not a one single trick. It's understanding how all financial pieces work together. And when people finally understand taxes, something powerful happens. They stop fearing money conversations. They stop being confused every April. They stop reacting emotionally. They start operating intentionally. And that's where financial confidence begins. Not when you make millions, not when you hit the lottery, but when you finally understand where your money is going and how to make it work for you instead of against you.